I know it sucks. It's a bear market. Everything's down. Whether you're talking about stocks or crypto or anything else, it really is difficult to be a long-term investor when you just see money going down over and over every single day. For a lot of investors, particularly anyone who's new to the markets, it can feel like the best thing to do would just be sell everything, go to cash, and never go into it again and never look at it again. But what I'm going to talk about in this episode are my strategies for long-term investing when it comes to bear markets. A bear market is typically defined when an asset or an index sells off by 20% or more. However, it's really an arbitrary figure. For me, I take a more intuitive approach to what a bear market is. If your asset, whether you're talking about crypto or stocks, just keeps selling off day after day and it just makes you really depressed, that to me is a bear market. It's just non-stop selling and you have no idea when it's going to end. As always, there are a few caveats to all of my videos. I'm not a professional, so when I discuss stuff in my video, it's what I do when it comes to my investments, and what I do might not be suitable for what you need. First up, if you don't have a regular income, then you're going to need some cash on the sidelines. And when you're reviewing your portfolio, what you need to do first is you need to take a look at your losers. When you review every single one of your investments, you need to ask yourself, is the investment thesis I had for that asset still intact? If it isn't, why am I still hanging on to that investment? If your investment thesis is broken and you have no other reason that you're hanging on to an investment other than you think you can win your money back, then you need to just cut your losses and sell the investment altogether. If it's no longer fitting your thesis, it's time to get out. Even though it sounds counterintuitive, a lot of investors will look at their winners and decide to take profits there because they have profits to take, rather than just cutting their losses when it comes to their losers. You need to remember that you always should continue investing throughout any kind of environment, even during a bear market. Part of the problem is you're going to hear a lot of people come out on CNBC and YouTube and claim that the market is going to sell off 40, 50, 60% or even more. And if you listen to them and you stop investing and you wait for it to sell off that much, it's possible that the market could find a bottom significantly before their bearish predictions. And if that happens and you're waiting, you will not invest. For example, if someone says the market's going to sell off to 40% and it sells off to 30% and starts heading higher, you're probably going to wait on the sidelines and not put money to work. Many investors will think that a market will test its lows or head even lower. So even during a rally after a bottom, people will wait on the sidelines until the market has gotten significantly higher before they put money to work. One of my personal rules is that I'm never right. I'm always wrong. And the reason I keep saying this is one of the most dangerous things an investor can do is to assume that they need to be right. In other words, you have to wait until that stock or that ETF hits your price target before you buy. And if it doesn't get that low, you just won't buy it. What can end up happening in situations like that is that you just never put money to work. You keep thinking it's more important to be right. Or worse still, you decide this is as low as this asset's going to go and I'm going to go all in right now. That's also a huge mistake because it's always possible that any asset can sell off lower than you can expect. When it comes to how to buy, I always buy in stages, and there's a variety of different ways you can do this. For me, I really like looking at charts of stocks, ETFs, and crypto, and I try to find key levels of support in the past where I'll make my next buy. But that won't be my last buy. I'll also look lower than that for additional levels of support where I can make my next buy. However, it doesn't need to be that complicated. If you're talking about an ETF that tracks the S&P 500, you can be as simple as just buying every 2.5% it sells off. Once it sells off 2.5% more, you make a small buy at that level, and then you wait for it to sell off another 2.5% and just keep repeating the process. If you're talking about a faster moving high growth tech stock like Amazon, you might want to increase that amount from 2.5% to 5 or even 10 or 20% when it comes to how much it sells off. For example, one of my favorite investments is Block with the ticker symbol SQ, and this little bugger can move more than 10 to 20% when it sells off. So you want to be much more widespread when it comes to where your next buy target might be. If you're a long-term investor that would prefer to just set it and forget it and not worry about your emotions taking over and preventing you from doing what you know needs to be done, you might look for a broker that allows you to do recurring buys. Some brokers will let you set it up so that you'll automatically buy a certain amount of money worth of a stock or an ETF every Friday. That way you don't have to worry about whether or not the asset's up or down. Your emotions will be taken completely out of the situation because it will just automatically make the buy for you regardless of whether or not the asset or the ETF is up or down. When it comes to long-term investing, the most important thing to remember is that it's time in the market, not timing the market, that matters. You can time the market and get better prices, sure, but it's more important to just be in it over the long term because most of the time the assets will just increase in value, particularly if you're talking about the S&P 500. One change I do make when investing in a bear market is I use much smaller quantities than I would in a bull market. If normally I'd buy 100 shares or 1,000 shares of an investment, I'll actually cut that back to 10 to 50 shares every time I buy in, since we don't know how low an investment could go. If you're a smaller investor and you can't afford to buy 10, 50 or more shares at a time, it doesn't matter anymore because there are fractional shares that you can buy. If you use a broker that allows fractional share trading, then you can divide your buys up by the amount of money you want to put in instead of the number of shares that you want to buy. Additionally, since there are no more commissions anymore, it means that you can just buy a share or less at a time without worrying about it. When I started investing in 1998, I used E-Trade and the commissions were $15 per trade. Even if you were a larger investor, a $15 commission going in and coming out can make an impact on your trade, so you had to take that into account when it came to buying levels and quantities, but that's no longer the case. If you're uncomfortable buying an individual stock during a bear market, then just don't do it. Instead, stick to ETFs that track a broader range of the stock market. In addition to ETFs like VOO or VTI that track the S&P 500 and the total US stock market index respectively, you can also look at specialty sector ETFs. As always, I really do like Vanguard. They have a lot of specialty sector ETFs, but there are other providers like iShares which have a lot of options when it comes to that. So instead of having to buy an individual stock when you're talking about the solar sector or healthcare, you could just buy the entire sector itself. Now, of course, if that sector gets hit harder than the rest of the market, you will see bigger losses than you would if you were in the S&P 500. You're also protected against any single company going out of business because the likelihood of every company in a sector going out of business is very slim to none. Finally, don't fixate on your portfolio. While it can be really exciting to watch your portfolio increase in value when you're talking about a bull market where it feels like everything's going up, it can be extremely depressing to fixate on your portfolio during a bear market. Watching all of your assets lose value can cause you to make a decision you wouldn't want to make, one that you make out of emotion instead out of a logical choice. Rather than fixating on how much one of my portfolios is going down, I like looking at the great deals that I'm getting, adding to positions that I'm going to hold on for the long term. I'm getting huge discounts when everything is selling off. However, if you find that you just can't handle the market gyrations, if the fluctuations are just too much, stop looking at your portfolio. Make a rule to only check in once a week or even once a month, but make sure that you do keep on investing. If you're a long-term investor like me and you have at least a 20-year time horizon or longer, then none of this is really going to matter. When we look at the past and we look at things like the Great Financial Crisis or the dot-com bust, you'll see that those things are very small in the scope of the overall movement of the market. If looking at your portfolio is driving you crazy, you just need to stop doing it. Go outside and do something else, because you need to remember this is not the most important thing going on in your life. In fact, it's probably not one of the most important things at all. If you just leave everything alone, you will likely be better off than if you made an irrational decision out of emotion during a bear market. To learn more, check out this video here. Thank you for watching, and I'll see you in the next video.